Demystifying Healthcare Valuations. I'll be your presenter today. My name is Chip Mazells. I'm the managing partner of Strategic Healthcare Evaluation Services and also a partner at Wyatt Mattis, which is a healthcare investment bank. As always on our webinars, you're welcome to use the question box on the GoToWebinar control panel and submit your questions, and I'll either get to them at the end if we have time, or I will email you after the presentation is over. We'll have a lot of data to cover today, so I'm not sure if we'll get to questions at the end to keep to our time commitments, but I will answer your questions after the webinar. So what we're going to cover today is demystifying healthcare valuations, and we'll dig in specifically into the market approach to valuing companies, which is the typical valuation method used in transactions, M&A transactions. We'll also look into a good bit of data around healthcare transactions over the last few months, including the public company valuations, healthcare transaction trends, and then we'll cover some specific segments. As you can see here, we'll also cover other segments along the way, but we'll dig into these particular segments in detail. So the first for us to start is why folks have valuations and why they're needed. The primary reason folks use valuations is for strategic purposes, and they're either using it for because they're considering exiting or acquiring a company, and they want a third-party opinion evaluation. They may need a place to start before they decide to sell their company, and they want to know the precise valuation or a narrow valuation range, or they're buying a company and they want to use the valuation as a way to for negotiating or find a middle ground. The other reason that they use it for strategic purposes is for exit strategy planning or strategic planning purposes. We go through a process called the Value Enhancing Strategic Process, which helps companies understand where their value is today, helps them define an exit plan and identify strategic initiatives and growth initiatives that will have the greatest impact on valuation over a period of time that they select. And it's a great way to leverage evaluation and the information that comes into the reports, and also get a clear focus for what your key priorities are for the company. Obviously, there's other reasons to use valuations in for tax compliance or resolving a controversy between shareholders, or sometimes it's a forced valuation during a divorce or a bankruptcy. And then there's also financial reporting needs that are needed if you're selling a company and you want to allocate the purchase price. Valuations are often used for that purpose. So this is what we call the business transfer matrix, and we use this when we start off. We always have to obviously know the purpose of the valuation, and the purpose of the valuation drives which methodology that we will probably rely on. We'll talk about the different methodologies of valuing a company in a minute, but this gives you a kind of an overview of the different reasons for selling, and whether it's the different reasons for having a valuation. And in a voluntary transfer of assets or the stock, you typically use an income approach or the market approach. We'll talk about each one of those specifically. And then in the involuntary approach, you're usually using the asset approach and sometimes the income approach. So these are the three broad types of approaches or methodologies that we use in valuing a business. The income approach is based on the entity's ability to generate cash, whether it's future cash flows and a discounted cash flow or historical cash flow in the capitalization methodology. The asset approach is usually used when you're liquidating a company, especially in healthcare. We rarely use the asset approach, although we run it in every valuation that we do. We rarely use it or rely on it to determine the final valuation. The asset approach is basically taking your assets minus your liabilities to determine the value. Defining the value of each asset is sometimes a challenge. Are you going to collect on the receivables? What is the physical property actually worth? And then there's goodwill and intellectual property sometimes that has to be valued or appraised as well. Then the market approach, and we'll dig more into the market approach in the next couple of slides. But the market approach is based on transaction data from similar companies or similar businesses, and so you're picking a sample size 5 to 10 transactions at least of companies that are in the same revenue side and in the same industry, obviously, and if possible the same geography. Especially in healthcare, we rely on geography a good bit. So the approaches, this is just stated in another way. The income approach breaks down into really two different methodologies. The discounted cash flow and the capitalized earnings approach. And we talked about estimated earnings and historical earnings. The market approach, we'll skip over the asset approach, but the market approach, you have two approaches or two methodologies there. The comparable sale, which is the actual transactions that you're looking at in a particular segment and around a revenue range, and then the guideline company methodology. The guideline company methodology is looking at publicly traded stocks and determining or evaluating the multiples and then applying that to the selling company. And we'll talk more about why that's less reliable in a moment for private transactions. So the market approach is the definition is the value of the company reflects the price at which comparable companies are purchased under similar circumstances. And so how do we get to that? I thought I'd walk you through that process. So typically what you would hear or what you hear most brokers or business evaluators quote as far as market range or valuation ranges is it's a range between 3 to 5 times EBITDA or 4 to 6 times EBITDA, and sometimes a multiple of revenue. And we'll talk about how we get to that multiple in a moment. And so that's basically taking your earnings, maybe adjusted earnings for owner salary or a normalized business cycle. You multiply that times the multiple, which is sometimes called the price to earnings ratio, and then you get your value. So if you had $1 million in EBITDA, earnings before taxes, depreciation, and amortization, and interest I missed, you multiply that times the multiple, in this case 5, and you get a value of $5 million. We get the earnings obviously from the company data. We analyze the financial statements. We adjust for normalization. The list of things that we can normalize for is long. It's probably a good one for its own separate presentation. But some of those things are obviously excess owner compensation. We adjust if, for instance, a home health care agency shuts down a branch in the middle of the year, and so we back out those costs of shutting it down and operating it. And if there was revenue to it, we back out the revenue and expenses from the income statement as well. But we're trying to get to the last 12 months or or a 12-month period of time, so we can analyze if the company was stabilized, or if the company had a normal 12-month period, what would those financials look like? And we get through that through management discussions and other company information. To get to the multiple, we look at the market data. We'll talk more about the comparable transactions and where we get those in a minute. We also look at industry benchmarks to see how the company performs against the rest of the industry around the specific metrics that are important to that particular industry or segment of the industry. We also look at industry expectations, and in healthcare, it's usually we're looking at the regulatory environment for that particular segment and how it fits into the rest of healthcare and what reimbursement trends are expected. And then we also look at the economic outlook. While we do look at the kind of macro economics of the economy, because that does speak to the ability of buyers to raise debt and equity for transactions. We mostly look at the overall healthcare economy and see how that particular industry segment fits into the global healthcare market or U.S. healthcare market. With that, we're able to generate the value. The information is obviously used for investment and growth decisions. It helps you decide whether now is the time to sell the business or whether you want to hold it and to increase the value. And then obviously it helps you determine the tax consequences of selling a business or buying a business with that information. So how do we get to that multiple, to this 5 times EBITDA or whatever that multiple of that price to earnings ratio? So where we generally start is looking at market data of transactions that have happened in that particular segment. In this case, we pulled some data here from the urgent care space, urgent care clinic space. I think in this particular valuation, we looked at 65 or so transactions. I narrowed that transaction list down a little bit just for presentation purposes. And then the next thing that we're looking for is to narrow the range of transaction sizes or revenue sizes of the companies being acquired. In this particular case, the company was $6 million in revenue, about $6 million in revenue. And so generally, we would have narrowed the search down from about $2 million to $10 million or so. I expanded that search a little bit here just to give you the ranges of deals that we're pulling from. And I think I expanded it from 1 million to 100 million just so you could see. And so the information that we get when we pull this, and the information that where we get this information is usually from our own collection of data and transactions, either that we're involved in or that come through us through other evaluators or brokers. We get it from databases like MergeNet, PratStats, Done Deals, PitchBook, Capital IQ. So we're aggregating all this data into one place. These are all subscriptions that we subscribe to and services that we subscribe to, and we generate a long list of acquisitions. The information that we get on the transactions is sometimes very deep and detailed, where we know exactly what the balance sheet looks like. We know exactly what the financial statements look like. We know what the deal structure looks like. Other times we only have deal price and revenue. The minimum amount of information that we need is deal price and revenue. We prefer deal price, revenue, and EBITDA. When we generate or when we draft a report, typically what we show, I took out some of the columns here just for presentation purposes, but we show the acquired company, a description of the acquired company, who the buyer is, the deal date, in the deal date, we want to keep it within, in healthcare in particular, we want to keep it within 2 to 4 years because of reimbursement changes that changes the dynamics of the marketplace and of the transaction multiples. So we, in this case, we extended it to 2012. We get the deal price, that's the amount that was paid for the company, and we get the revenue of the company. We get the EBITDA of the company if it's available. It's not always available. And then we're able to figure out, if we're not given it already, the deal price to revenue multiple and the deal price to EBITDA multiple. So when you get this in a report, it's pretty valuable information in itself, because you get to see who the buyers are and what they're buying. And that's valuable because if you're thinking about selling your company, that becomes your buyer list. And then you get to see, obviously, the valuations that are being paid for different size companies. We then consolidate that data in order to get to the median EBITDA multiple or revenue multiple. And so you can see here in the transaction multiples of all transactions, we've broken it down to high, upper quartile, median, and mean, and so on. In this case, the median was $4 million. The deal price was $4 million, and the revenue was $3 million. Again, this particular company was in the $6 million in revenue, and so we probably would have tightened up the value, the comparable range to between 2 and 10 million, and try to get some good data around there. Again, we want at least 5 to 10 transactions in order to have a good sample size, and in that comparable range. So with that data, we now know that the deal price to revenue multiple is 1.05 times revenue, and the EBITDA multiple is 6.24 times revenue. We then apply that to the company, the subject company's sustainable performance, and this is the revenue and EBITDA that we normalized. So 6 million times 1.05 is 6.3 million or so, and EBITDA was 765,000 times 6.24, the median EBITDA multiple that we found above. We generally, in this case, we weighted the average. Generally, we don't weight the average when we have enough EBITDA. So first, let me say that we would rather have EBITDA multiple than revenue multiple. Most transactions are negotiated around that EBITDA multiple. So if we have enough 5 to 10 transactions with EBITDA multiple, then that's what we would use. We would not weight the averages. We did weight it here just for presentation purposes. Above, back on the other side, you can see we had plenty of EBITDA multiples to determine the median. So we would have, in a normal case or in practice, we would have used the EBITDA multiple. So the valuation would have been 4.76 times, or $4.77 million. So that gives us the enterprise value, and then to get to the equity, we subtract out the debt on the balance sheet, interest-bearing debt, and add cash, because usually transactions are the owner keeps the cash. So that gives you the market approach and how we get to all the information that we need to determine that company's valuation. So we talked about the guideline method of using publicly traded companies, and I show you this chart. There's a lot of information on it, and I break it down in a couple of other slides into more digestible information. But we keep close tabs on each of these segments, and this data in order to see how the markets are favoring each segment or not favoring each segment. The main things that we look at on this chart are the change in stock price for the past 3 months and the past 12 months. That gives us a good sense of whether the companies are in favor or out. We also look at the EBITDA multiples of revenue and the multiples of revenue and the multiples of EBITDA for the last 12 months of a company's performance. We do look at, we don't weight it as high, but we do look at forward multiples as well. But the primary thing we're looking for is this historical data in this case. Overall, you can see healthcare has performed fairly well as it relates to the S&P 500. If you look down at the bottom at the healthcare index for all segments, S&P 500 performed at, it was basically flat for the past 3 months and up 11%. Healthcare was 4.2% and 15.5% respectively. So if we break this data down a little bit further, and let me just go back and say one more thing here. We generally do not use, while we run the guideline public traded valuations to give us another data point in our valuation, we rarely rely on it to determine the value. Most publicly traded companies are valued much higher than smaller transactions. It's usually a 20 to 50% discount from privately held companies. The main reason is these are publicly traded companies, so they can trade their stock freely. There's a ready market for their company or for their stock. In a private transactions, it's less so. It takes 6, 8, 10 months to sell the stock of a company or sell a company and to access the value in that company. And so there's a significant discount. It's called the lack of marketability discount that's usually applied, and it's different for each segment. What that discount is different from each segment. It's different to the size of the company and a lot of other factors that goes into it. This is the publicly company data is interesting to look at. It helps us monitors the segments, but it's less useful in evaluation. So I mentioned that we looked at the median percent change in the stock price over the 3 months and 12 months. That gives us a good sense of how each segment is performing. Because the S&P 500 returned was basically flat, so anything above 0, that segment outperformed. Anything below it underperformed. You see disease management as health and wellness companies have done quite well. One of the main reasons there is United announced that they were acquiring Alere, so that drove up the valuations for that segment. I know we have some practice management folks, physician practice management, that continues to do well. This has been doing well for quite a while. Healthcare staffing continues to do well. This is a segment that really struggled 4 or 5 years ago, and it's really rebounding nicely, and those companies are doing well. We'll talk more about that later. And you can see the rest, home care, hospice, home infusion. I know we have a few of those on there on the call as well. That's also performed pretty well, at least above market. Over the last 12 months, as you see, it's done really well. So this is a 12-month median change in stock prices by segment. Again, we're looking for trends to see what's doing well and which segments are doing well. Home care, hospice, and home infusion. The companies seem to have stabilized, and it's reflected their stock price over the last 5 years, or at least since 2010. It was significantly underperformed. I think they're now averaging about 11.5 times EBITDA. Just 2 years ago, they were down around 5 or 6 times EBITDA, so it's really done quite well. Some other ones I'll point out: physician practice management. We expect this space to continue to do well. Healthcare IT. Where is that? Can't pick it out quite here, but that has done a little bit better. For the last 12 months, it had been pretty flat. I just don't see it here for some reason. But it's since stabilized. One of the reasons why it hasn't done as well, although valuations are very healthy there, is that there had been a run-up in valuations between 2012 and 2014. Valuations were over 20 times EBITDA at the time, where the market was generally trading around 15 times EBITDA. And so you really can't expect that to continue to outperform the market much more than it already has. So this is some of the transaction. These are transactions that have, this says private equity interest in healthcare. These are all transactions in healthcare by quarter. The 2015 quarter, this is only through January. We don't have February data quite finished yet. I've broken it down in two ways, transactions and I've broken it down by types of acquirer. The strategic acquirer, so those who are already in the business of whatever that segment is, and then the private equity acquirer or the financial buyer. You can see that the strategic buyer dominates the space. We'll look at this. We'll look at this data in a little bit more detail in a second. But transactions still kind of carrying out, but around 290 to 300 per quarter, and that's fairly healthy transaction volume. If we were to look back over in 2010, we were doing about 200, right at 200 transactions per month, or per quarter, sorry. We're expecting a pretty strong 2015. The market is fairly stable. We know what reimbursement cuts are coming. There's some kind of crazy legislation that's coming through that's always there to try to revoke the Healthcare Reform or Accountable Care Act, but for the most part, everybody feels comfortable the way that the most segments are operating, and transactions seem to be flowing quite freely without fear of significant regulatory changes. That might change as we get closer toward 2016 and the presidential election, but for now, we expect to see about 300 to 350 transactions per quarter for 2015. So this is the private equity interest in healthcare. And one of the reasons we like to look at this is because they tend to be industry followers, and we can tell when they're starting to invest in a segment that the valuations are probably are peaking, starting to peak. These are investments in private equity investments for the last 3 years. The top chart or table, you can see healthcare services has always been an attractive space. Healthcare facilities, which is interesting because most people's opinion is that facilities will be less valuable as healthcare reform is fully implemented as we move toward value-based care. But there's a lot of addiction, behavioral health, addiction and substance abuse clinics that are being bought and sold, as well as assisted living would be included in this as well. Healthcare technology is, when I see this number, there's a lot of transactions that happen in that space. Private equity doesn't participate as much there. The main reason is because valuations have been so high. Private equity tends not, they rather pay a bargain than a premium, and so they typically can't compete for these kind of transactions. They typically, healthcare technology transactions, they typically go to strategic buyers. On the lower chart, the private equity investments and exits, if you see from 2011 into 2014, we've had more exits in private equity than acquisitions. On the surface, this would be a little bit disturbing. However, most of these transactions that they've exited in since 2011 were transactions they had been in a very long time, since even some before 2004. If we took this back further, you could see, and you can see in 2004 through 2007, that acquisitions were higher than exits. The main reason, and private equity groups and investment groups tend to only want to keep those companies between 3 and 7 years, and 7 years is really the max. It's more like 3 to 5. When the recession hit in 2008, it was hard to exit out of any of these companies. Plus, you had the threat of healthcare reform coming, and then it actually came, and it took a little while for the equilibrium of sellers and buyers to work out. So a lot of these private equity groups had to hold these companies a lot longer, and so now you've seen a significant rise in exits. The other challenge that private equity is having is it's becoming more difficult for private equity groups to raise money, and this typically happens when you have a robust public market where you can get a 12 to 15% return. Private equity groups have had a tough time showing or demonstrating their value proposition when their return on investment is usually between 8 and 12%. And it's considered a more risky investment, and so folks tend to be going toward the public markets rather than the private equity markets. And so there's not as much capital to invest through private equity as there might have been in 2004 and 2006, through 2006. So now we're going to get into some of the sector coverage. We have about 10 minutes, I believe, and I think I'll be able to get through it. Just one point that I want to make here before we move on. We're talking about broad segments here, and a lot of these segments have subsectors, and valuations are different, very different from sector to sector and subsector to subsector. So we use valuation ranges to discuss the valuation multiples. And I would suggest that you be careful in applying these valuation range to your company. They can be deceptive, and we probably, and I'm always nervous about providing these valuation ranges because I think people read too much into them. Almost all owners believe they're at the top end of the valuation range, and that's not always the case. It also varies geography to geography sometimes in some segments, and I'll mention some of those. So you just have to be careful with these. A business valuation is very inexpensive. It gives you a precise value or a very narrow valuation range. It gives you a lot of information, so it's worth, if you're considering some significant strategic initiatives or exiting, then it's worth having a valuation done. So first we'll talk about healthcare staffing. You see healthcare staffing has really rebounded nicely since the recession. The healthcare staffing tends to be follow the economy. If you looked into these transactions more specifically, especially in 2013 and 2014, we see very little kind of local staffing companies being acquired, the typical nurse per diem staffing. Most of these acquisitions are more specialty. We put hospitals in healthcare staffing, but these are mostly specialty staffing companies that have a niche, whether it's staffing physical therapists or operating room nurses or behavioral health specialists, or whether it's a niche travel company. And that's where most of these transactions are going. The larger publicly traded staffing companies, healthcare staffing companies, have done a really nice job of transitioning from more per diem staffing to the specialty staffing, and they've done that mostly through acquisitions. So depending on segment and subsector of segment of healthcare staffing, valuations have been in that 3 to 6 times EBITDA range. The more specialty, the more niche, and the more scale that you have, the higher the valuation is going to be. We've even seen a couple of transactions here recently in the at 8 times EBITDA, but we're not exactly sure if that's a trend or just a blip of those particular companies. But it's been a very healthy market. A lot of buyers and starting to become more sellers in the space as well. So we got a nice equilibrium happening in healthcare staffing. Behavioral health. The behavioral health space. This is a really broad space and covers a lot of territory. The spaces but you can see that the transactions have continued to increase. We expect this year that we'll do about 25 to 30 transactions a quarter. Most of those transactions will happen in the addiction and substance abuse space and the autism space. I believe that we just started to see this in late in 2014, but we're also seeing quite a few transactions in the kind of in-home behavioral health space, sending behavioral health specialists into the home. This makes sense with all the dual eligible population, and you're going to have to address the behavioral health needs, as well as just the evolution of more recognition that we need to pay more attention to the behavioral health conditions of medically ill patients. We've seen a big range of valuations. There's a lot of not-for-profits in this space, and those tend to be less profitable with a lot of transition risk from for-profit from not-for-profit to for-profit, and so valuations tend to be lower there. Those for-profit companies, though, that have been able to sustain a nice margin are seeing really healthy valuations up to 8 times. This is also, in a lot of cases in behavioral health, it's very state specific what valuation ranges are going to be, and sometimes even county specific, depending on what reimbursement opportunities are available. And so these are healthcare behavioral health valuations are generally harder to do because you really have to dig into all the different reimbursement opportunities that some of these groups have, especially if it's a not-for-profit. And I think I said this, we're expecting kind of in that 25 to 30 range for 2015 on a per quarter basis. Medicare home health is still trading in that 3 to 5 times EBITDA, although we've seen some strength in that space here lately. 2014 transactions were down compared to 2013. Primary reason for this is there's still just a disconnection between buyers and sellers on what the valuation range is. We're still seeing these big transactions that are happening. We'll get 1 or 2 per quarter that are trading at 8 times EBITDA. A good example of this is HealthSouth's acquisition of Encompass, and then obviously Kindred's acquisition of Gentiva. And when buyer or sellers or business owners see these valuations at 8 times, they try to apply that to their own company. They go to market expecting 8 times or more, and they're disappointed when either the valuation or the offers come in at below 5 times. And this has been the disconnect in the market really for the last 2 years. We should be seeing, because of the size, the number of companies in this space, over 10 or 11,000 at this point, you would expect more consolidation than just 54 transactions in 2014. It's also very geographic specific. A lot of folks are just, buyers are no longer acquiring in Florida anymore. We were seeing lots of transactions up until 2010 and in Florida, and now we rarely see any transactions in that state. It's a crowded market. Lots of home health care providers there. They struggle with fraudulent providers as well, and for the most part, and states are the state of Florida, and some other states as well are putting more stringent regulations on and oversight on these home care agencies as well. So we just don't see as many transactions there as we really should. That said, this first quarter of 2015, we've seen some of that loosen up across the country. I think folks are starting to accept what their valuations are. We kind of know where reimbursement is going at this point, and so we maybe see some transactions pick up. I still think valuation range will be in that 3 to 5 range. The last point I'll make is we're seeing transactions take longer to get done for 2 primary reasons. One, we just don't have as many buyers in the space as we used to. Generally, a transaction should take 6 to 9 months to get done, and we're seeing companies stay on the market longer than a year, mainly because they can't find a buyer. The second part of not being able to close in a timely manner is just the regulatory issues of transfer of ownership have increased in some states or by some intermediaries, and so it's just taking longer to get done. And in some cases, these companies who are struggling, especially small providers who are struggling, can't wait a year and end up closing the business before they're able to sell it or before they're able to complete a transaction. We've seen quite a bit of that in 2014, and we'll probably see more of it in 2015 because margins are so thin these days in the Medicare space. Hospice transactions, I think we finally hit an equilibrium there and a connection between buyers and seller on prices. The main driver of this decline in transactions has been the average length of stay has been a focus for regulators, and that folks are worried that they're going to add more regulations on the industry to drive down the average length of stay. There's a Wall Street Journal article that came out in 2013, late in 2013, that talked about, actually it's early in 2013, and that talked about privately held for-profit companies have an average length of stay that's almost double that of not-for-profits. And I think it was around 160 days or so, where not-for-profits were around 80 days or so. And so at the time, valuations were somewhere between 6 to 8 times EBITDA, or somewhere between $45,000 and $55,000 per patient on average daily census. With providers driving down their average length of stay to between 80 and 90, or at least under 100, you're seeing those valuations fall to 4 to 6, and somewhere between 25 and 35, depending on what the average length of stay is. I think sellers still think they should be paid $50,000 per patient, and I think rightly so. Buyers are saying, no, that's probably not right. It's more like $30,000 per patient. But we think we're just starting to see some that come into balance in transactions. This is a strong space. The use of hospice is going up nationally. And the recommendations from physicians is going up nationally. So we expect these transactions to pick back up here in 2015. So other spaces in home care, home infusion, there's not a lot of pure play home infusion companies out there, so they tend to command a premium. We've seen some nice size transactions in the last 2 quarters, and we've seen a lot of companies do de novo expansions into new territories too. They prefer to acquire. These are not the easiest companies to start up, but and it's costly, much more costly than a Medicare home care or private pay company. So they prefer to acquire. So valuations have been, compared to other home care segments, pretty healthy. Private pay home care, this is really kind of two things drive private pay valuations. One is the size of the companies. We don't see that many companies over $5 million in revenue, so it just tends to keep valuations suppressed. And the other thing is geography and how competitive it is. I think the more urban markets, valuations tend to be a little bit lower, mainly because of the competition in the space, and the worry that once a company is acquired, do you lose some of the staff? And private pay is really dependent on staff, obviously. And so we as I look at this market, I think it's got a lot of upside, and it should be trading somewhere closer to 6 times, but we just don't see that many transactions in that range. It's probably closer to the 3 to 4 than 4 to 5 times if you looked at it on the aggregate. But it's a good space. I think eventually, as we start to see more provider scale, then we'll start to see valuations expand. The Medicaid and personal care space, it's been a tough slog in that. This is really a state-by-state valuation that you have to go through because of the different reimbursement methodologies and reimbursement rates. I tend to think that valuations are going to improve in this area as we get into the more dual eligible populations. For instance, in Ohio, we've had some of the insurance companies approach the Medicaid companies because they have access to patients better than some of the Medicare companies do. And so they've approached them and say, let's create a new methodology of payment, almost shared savings or per member per month basis. So it's interesting. This space, I think, will evolve, but right now valuations are pretty suppressed. Our final segment is outpatient physical therapy. This has been, especially over the last 2 years, really improved, and we expect this to continue. We do think we may be at the peak of the market. Valuations have really been driven up. There's less activity from the private equity-owned physical therapy companies who are really doing most of the transactions. You're seeing more regional companies doing acquiring the private equity groups. Also seeing national companies acquire, but a little bit less so. So we may have hit the peak of the market. It seems, but valuations are very healthy here. There's a lot of small transactions that happen in this space. If you have more than one clinic, then your valuation goes up fairly significantly from one clinic. So this is a very nice space as well. All in all, healthcare services is doing quite well compared to a couple of years ago. Valuations tend to have at least stabilized, if not improved, a little bit, and so we're encouraged by that. So that's all. I see we've had some questions come in that I will answer after the presentation. We do have what we call our valuation workbook, where we put out this information every month that covers all the publicly traded companies and a lot of the private equity companies that are acquiring, and you can follow their valuations that are obviously more public than the privately held transactions. We'll be sending that out, I believe, next week for our March report. So if you don't receive it by next week and you're interested in it, please email me and I will make sure you get a copy of it. Thanks for joining us today, and we look forward to seeing you on our next webinar. Feel free to call me with any questions. Thanks.